If you have $500 in internet access, you can build an ETF portfolio today, not someday, not when you save more. Today, I'm going to walk you through three specific strategies that work for small investors, and the third one is the one most people skip, but it's the one that actually makes the difference. So grab something to drink and let's get into it. Here's what most people get wrong about ETFs. They think you need thousands of dollars to get started. You don't. Major brokerages like Fidelity, Schwab, and Vanguard all offer accounts with no minimum deposits and the ability to buy fractional shares. That means your $500 goes to work immediately, split across multiple funds if you want. Let's start with the easiest move you can make right now: opening a brokerage account and putting your money into a total market ETF. Point number one, grab a total market ETF and forget about timing the market. I'm talking about funds like Vanguard's VTI, which holds over 4,000 companies across all sectors and market caps, or iShares ITOT, which does basically the same thing. Why does this work? Because you're buying a slice of the entire American economy. You're not betting on one company. You're not trying to pick the next Amazon. You're just holding everything. The S&P 500, which is the basis for funds like VOO, has returned about 10.5% annually on average since 1957. That's the long-term average. Some years are brutal. Some years are incredible. But the long-term trend has always pointed up. My friend Dave at work, he started investing $200 a month into VTI in 2019. By 2023, his account was up over 30%, even with the market turbulence in between. He never checked his balance. He never panicked when headlines looked scary. He just kept buying. Now, here's where things get more interesting. Once you have your total market ETF, it's time to think about international exposure and balance. Most people stop at VTI and call it done. That's a mistake. Because when American markets struggle, international markets often hold up better and vice versa. Here's what you do. Take that $500 and split it. Roughly 70% into your total market ETF. About 20% into an international ETF like Vanguard's VXUS, which covers 9,000 companies across 47 countries. And the remaining 10% into a bond ETF, something like BND, which holds over 9,000 bonds and gives you stability when stocks get wild. I know what you're thinking. 10% in bonds seems small. But bonds did something interesting in 2022. While the S&P 500 dropped about 18%, BND only lost about 13%. That cushion matters more than you'd expect when you're trying to sleep at night. The expense ratios matter too. VTI charges you 0.03% per year. BND charges 0.03%. VXUS charges 0.07%. Compare that to the average actively managed mutual fund, which often charges over 0.80%. Over 20 years, that difference compounds into tens of thousands of dollars. If this is clicking for you, hit that subscribe button. I drop videos like this every week, and the third strategy is the one that most people never actually do, but it's the one that turns good returns into life-changing returns. All right, this is the one I've been building toward. Automate everything. Not the exciting answer, not the flashy answer, but it's the answer that separates people who build real wealth from people who read about building real wealth. Set up automatic investments from your bank account into your ETF portfolio every single month. $50, $100, whatever you can manage without straining your budget. This is called dollar cost averaging, and it sounds boring until you see the math. Let's say you start with $500 and add $200 every month. In 10 years, at an 8% average annual return, which is below the historical average for a stock-heavy portfolio, you'd have roughly $68,000. Take that same timeline and add $400 monthly instead. You'd be sitting on over $120,000. The money you contribute matters, but the consistency matters more. A 2023 study by the Financial Industry Regulatory Authority found that people who automated their investments contributed 73% more annually than those who invested manually. They didn't earn better returns. They just didn't give themselves the chance to stop. The moment you make investing something you have to think about, you give yourself permission to skip it. Automation removes that choice entirely. And here's the part nobody talks about enough. Once your portfolio hits $50,000 in a tax-advantaged account like a Roth IRA, and yes, you can hold ETFs inside a Roth IRA, the game changes. Your money grows tax-free forever. No taxes on dividends. No taxes on gains. Someone who puts $10,000 into a Roth IRA at age 25 and never adds another penny will have more money at 65 than someone who puts in $20,000 starting at 35. That's compound interest. That's time working for you instead of the government. Let that sink in for a second. So there you have it. 3 real ways to build an ETF portfolio starting with just $500. Get a broad market fund first. Add international and bond exposure for balance. Then automate everything and max out a Roth IRA when you can. The first step takes an hour. The second step takes 10 minutes of reading. The third step takes setting up a transfer and then forgetting about it for decades. That last part is the secret nobody wants to hear because it's not sexy. It's just math. If this helped you, hit that like button and share it with someone who keeps saying they'll start investing someday. And subscribe. I've got more on ETFs, compounding, and building actual wealth coming up next. Until then, go open that brokerage account. Your future self is waiting.